You have probably heard the saying, cash is king. But in today's high inflation environment, letting your cash sit idle just won't cut it. Instead, why not put some of that spare cash to work by investing in dividend stocks? In this video, I will share 3 powerful investment strategies that can beat inflation and guarantee you positive cash flow by contributing $15,000. By adopting these long-term approaches, you can build a diversified portfolio that lets you live off dividends and retire early. Tune in and discover how to make your money work for you. The first strategy is to invest in blue-chip stocks. These are large and well-established companies known for their financial stability and long-standing market presence. Blue-chip stocks, typically with market capitalization of billions of dollars, are less susceptible to market volatility because of their robust financial health. That means investing in blue-chip stocks carries lower risks. These companies have a long history in the market, leading to strong brand recognition and loyal customer bases. As a result, the profitability is sustainable. As long-term investors seeking continuous dividend payments, especially during economic downturns, blue-chip stocks are a reliable choice. Take Coca-Cola, for instance. With a market capitalization of $275 billion and a history dating back to 1886, Coca-Cola exemplifies a blue-chip stock. Despite over a century of war with PepsiCo, the company earns strong brand recognition and customer loyalty, making it a staple for many customers. This loyalty allows Coca-Cola to raise prices without sacrificing sales in today's high inflation environment, resulting in increased dividends for shareholders. Over the past 3 years, the dividend growth has averaged 3.56% per year. While this may not seem significant, it demonstrates the company's commitment to rewarding stockholders. More importantly, Coca-Cola has consistently paid dividends for 61 years. It has built up confidence for investors that the company will continue paying and increasing dividends in the future. In the U.S. stock market, there are many blue-chip stocks like Coca-Cola. Some of the best companies are Pfizer, Northrop Grumman, and Kroger. Their dividend yields are 6.13%, 2.23%, and 2.27%. These numbers are not impressive, but they all have amazing dividend growth rates in the past 10 years. Respectively, they are 5.77%, 11.73%, and 13.66%. Now, the average dividend yield is 3.41%, and the average dividend growth rate is 10.39%. By investing $15,000 to these 3 blue-chip stocks, the portfolio would be $48,476 with an annual dividend of $1,632 after 10 years. In 20 years, the investment would be $177,767. Now the annual dividend is $5,902. After 30 years, the investment would become $649,237. The annual dividend is $21,258. This is equivalent to $1,772 per month. Because the dividend growth rate is so high, compounding over a long time would build substantial wealth. However, the dividend payout is relatively low. Can we get a higher dividend yield from other investments? Let's see the next strategy. Now, let's explore the second strategy, REITs. REIT stands for Real Estate Investment Trust. Imagine you and your friends want to invest in real estate, but none of you have enough funds to purchase it. Instead of taking a mortgage, you all decide to pool money together to purchase a property and share the rental income from tenants. REITs are similar to that. As individual investors, we can purchase REITs in the stock market through real estate companies like Vici Properties and Realty Income. Real estate companies use our money to purchase properties like apartments, offices, warehouses, and malls, and then lease to business owners. Each month, we as individual investors will receive part of the rental income as dividends by owning shares of these real estate companies. In the past 2 decades, real estate has experienced significant growth. There are individual investors like us who have made great profits from investing in REITs over the years. Some are even living off dividends provided by REITs. REITs offers us a very low threshold to participate in the real estate market and without worry about actually owning the property. In the near future, healthcare, data center, and residential REITs are expected to have high growth. Since REITs are paying investors once every month, it is a great choice for people to receive steady income and helps investors budget better. Some of the best REITs are Agree Realty, Crown Castle, and Iron Mountain. Each of them have a dividend yield of 4.91%, 6.22%, and 3.04%. The dividend growth rates are 5.93%, 24.49%, and 9.18% accordingly. The average dividend yield is 4.72%. This is higher than the average of the last 3 blue chip stocks, and the average growth rate is 13.20%. Pretty good growth rate as well. Invest $15,000 in these 3 REITs and reinvest all dividends. What do we get out of it? In 10 years, we would have $46,642 in the portfolio, and the annual dividend is $3,632. In 20 years, our investment would be $235,938. Now the annual dividend is $32,043. In the 30-year mark, the investment would be worth $2,217,726 with an annual dividend of $525,300. This is about $43,775 per month. Economy plays an important role in the real estate market as well. So REITs are riskier than blue chip stocks, but the reward is higher. If you don't want to miss the opportunity to grow your wealth with REITs, we will show you a portfolio that is safe and offers high yield in the end. The final strategy is covered call ETFs, which can generate passive income faster than the first 2 strategies. Investors benefit from stock price appreciation, dividends, and selling options. Stock price appreciation and dividends are straightforward. How about selling call options? That involves granting someone the obligation to buy a stock from us at a predetermined price within a specific time period. In return, we receive a payment called premium. The premium will be distributed to investors as a dividend. The challenge is that not a lot of us can easily predict the price movement. However, we can take the advantage of covered call ETFs because the fund manager does options for us. We are still making profit while not knowing how options work in depth. This method can offer us an additional source of income. For people working 9 to 5, we can focus on our day jobs instead of price movement. With the premium as an additional stream of income, we can see why the dividend yield is higher. Most covered call ETFs are offering over 10% of dividend yield. Compared to blue chip stocks and REITs, covered call ETFs are riskiest. Therefore, the dividend yield is higher. Some of the best covered call ETFs are QYLD and PBP. They all have good returns over the years. QYLD has a dividend yield of 11.64%, and PBP has a dividend yield of 13.82%. The average dividend yield is 12.73%. For a $15,000 investment, the investment would yield $1,910 after a year. Compared to the last 2 strategies, covered call ETFs do not have consistent performance. In fact, QYLD has had negative dividend growth in the past 5 years on average. The dividend payout could vary depending on the market conditions. Years later, the annual dividend payout could still be around $1,910. Additionally, the share price appreciation may not have steady growth. For investors looking for passive income over long-term growth, this strategy may be suitable. Based on the riskiness of each strategy, we will build an investment portfolio to maximize returns and minimize risks. Let's place 40% of the fund in blue chip stocks, another 40% of the fund in REITs, and finally only 20% of the fund in covered call ETFs. Now we are going to invest $15,000 into this portfolio. The average dividend yield is 5.8%, and the average dividend growth rate is 10.44%. In 10 years, the investment would become $49,207 with an annual dividend of $2,921. In 20 years, the investment would be $255,963. Now the annual dividend is $15,686 per year. In 30 years, the investment would grow to $1,164,566. Now the compounding pays off. The annual dividend becomes $73,462. This is equivalent to $6,121 per month. This amount is not very high, but it is relatively stable. Meanwhile, we have earned over $1 million from the investment by only investing $15,000. Blue chip stocks, REITs, and covered call ETFs are 3 simple investments to generate passive income. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.